Hello everybody. Today I'd like to walk through my stock portfolio as at the end of September. It currently stands at 89,000 give or take. I've made some changes this week. Hopefully it'll be a little bit more concise. We'll be able to spend a bit more time diving into a few companies that I want to talk about, why I've increased my holding or my rationale for holding them as it stands. So without further ado, let's do it. Alright, so I've made some changes here already to the walkthrough. You'll see here that I've tracked my portfolio from when I started. In terms of my September performance, I did manage to make a profit. I know that isn't super common. September was a really difficult month. I was definitely quite fortunate in my holdings. I had a lot of value shares. I sold out of almost all of my big tech club stocks, above what they're currently sitting at. And also my largest holding had an activist investor take an 8% share, which sent the share price up quite rapidly, so that felt really good. Without the activist investor, I would have struggled to break even. I would have made a £100 profit once you included the dividends, but that definitely boosted me over. I am quite an active trader. You can kind of see that in the top table as well when you look at the buy and sell. And if you look at the table there I just brought up, you'll also see the realized profit is a fair chunk, actually almost all of it. My unrealized profit at the end of September was actually minus £1, and then my dividends 1,700 and counting. So currently on my net profit, all things said, is about 10,500 there. And yeah, obviously really pleased. Well, by the way, we'll see in a second how that compares month on month with both the S&P 500 and the FTSE All-Share. Part of my journey into stocks is to see whether I can beat the market. Sort of giving myself 3 years, and if I can't, then we'll just stick with boring index funds. But actually, I really like researching stocks, and it's good fun. This is a different way of looking at it. Everything should match, basically. There is a pound because of rounding differences here in some of the subtotals, but you'll see that they all match. So again, just a slightly different way of looking at it. So yeah, my portfolio stands at 89,000, of which 78.5 is capital contributions, and the rest is profit. So yeah, broadly speaking, felt really vindicated this month. Like I say, a lot of the things I've been sitting on came good, and even where I'm still sitting on some stocks which are in the red, they are less red than they were previously. Also, my top 2 holdings are both involved in takeover talks of various things, and again, we'll talk through those when we get to the individual stock breakdown a little bit later. But this is how it's going. Super happy with my performance in September, honestly. And yeah, we're going to look into the breakdown in a bit more detail now. Alright, so this graph isn't new, although I have moved it to where it appears in the presentation here. Something else that's also interesting, I think, with this graph is the fact that what happens on basically the 19th of every month is that my portfolio gets absolutely spanked. I don't know if it's the the Fed meeting that does it, but it just seems incredibly consistent. I have some of the worst days. You can see it on the graph, right? That's super consistent. They're a month apart, those big drops. And the final big increase there is because of the activist investor that really just added £1,000 profit to my portfolio overnight, so that felt pretty good. And although there was a period in the middle of the month where I was struggling to have any profit at all on my UK shares, they did show a little bit of a bounce back. But you can gradually see actually my UK shares have been drifting lower, eating into the profit that I'd made previously. And again, that's not ideal, but hopefully we're starting to see a reversal of that. This graph is new. I actually borrowed it, or pinched it, I suppose, from investments, but specifically from a pension portfolio that does a similar measurement. And what it does is, because obviously I'm quite heavily contributing capital very quickly, it attempts to kind of explain it a little bit better as to what my performance really is like. So what it does is it assumes that, at the start of December, if you put £100 in my portfolio, £100 in the S&P 500 and £100 in the FTSE All-Share, this is what it would look like today. So that's really the purpose of this, to kind of strip out some of the fairly chunky capital contributions. Obviously, if you've only put in 10 grand for the last 2 months, there's no way that you're going to have a yearly annualized performance of 8%, right, or better. So it's probably a fairer way of assessing my performance as a result. You can see here I had been gradually broadening against the FTSE All-Share, despite a difficult graph there on the left. But I had actually been behind the S&P 500 really since I started to focus less on big tech. The main reason why I sold out of big tech is I just thought it was all overvalued. Sold out of Microsoft 291, Apple at 148, Danaher, I don't think you can count that as big tech, but I sold out at 290. It's a good company though. Amazon I sold out at like 3,460, which maybe isn't so overpriced, but I felt like there were better value plays elsewhere. So yeah, broadly speaking, I just have very little in that, which was making me fall behind until this month when the S&P got sold off quite heavily, especially the Nasdaq component. Whereas again, my portfolio benefited from some of the value plays as well as some of the other stuff there as well. So that's kind of the result here of what you're really seeing. So I would also point out as well. So Telecom Plus here, this is a unified utilities company that I've had for some time. It had a bit of a bump. I explained this in one of my weekly videos, but basically in the UK at the moment, a lot of retail gas suppliers specifically are hitting the wall because of some regulated cap and wholesale pricing increasing. Telecom Plus is seen as one of the winners because it's very well run, not too much debt. It has this, other revenue streams as well. And I decided to sell it for about 4% profit. I do think I sold it maybe for, it was still probably about 10% undervalued. But I had been sitting on about, 15% loss, and then it went up 20% in more or less a week. So I decided to exit it. Also, as well as you'll see in a little bit, I decided instead to kind of focus on more of a high quality UK telecom company that probably most people haven't heard of, whereas this was more of a value play. So I just decided that I only really wanted one UK telco and decided accordingly to sell. The other one here, this is National Express, who are one of my second largest holding and have also been involved in the takeover battle. Slightly different here though, they're actually considering buying a very large bus company called Stagecoach. The founders are looking to exit from Stagecoach. It's still a fairly chunky acquisition for National Express. It's about a third of their value. I'm not 100% sure I like it, but I'm trying to be supportive. I do generally like the direction of National Express, and as I've spoken about before, I think it's overseen as a COVID stock. Like, sure, it's impacted, but a lot of its travel is intra-company, and once things like coaches, shuttle buses, school buses get up and running, where I tend to be relatively confident we will start to see those things getting up and running, I'm pretty sure they're going to make lots of money. They're already earning more than they were pre-COVID, and their revenues are about 85% of pre-COVID levels on a like-for-like basis. They bought a couple of smaller companies, kind of at low 8 figures, and are actively looking to buy distressed companies. I think it's a good company, honestly, National Express, and that's why they're my second largest holding. So there was some life in that. Basically, I think the market kind of had a relook at National Express, because even though nothing has fundamentally changed at the business, the fact that they were in the news about a possible tie-up, basically purchase of Stagecoach, sort of made people reconsider. So my National Express share price has been all over the place, and because I have such a large holding, it doesn't take much movement to make quite a big swing. So that's been quite a fun ride in September as well. So that's all contributed effectively, but all things being equal, again, happy with what I'm seeing here, and actually surprised that I'm just about running ahead of the S&P at the moment. That was unexpected, but that feels really good. So I'll update this moving forward, and hopefully we'll get a more realistic comparison from my performance against those two indexes where I'm invested. Okay. All right, so in terms of sector, I won't spend too much time here. This isn't how I imagined my sector breakdown would look when I started. I had like very clear ideas, I want 20 to 25% in tech, 10 to 15% in healthcare, financials, and discretionary, and it just didn't happen at all. And I realized that, I like to trade, and I think I'm a bit of a value conscious investor, I've come to realize over the last 10 months. And I just, I kind of fell in love with one or two shares. So, defense and industrials there is almost entirely Huntsman. Transportation is almost entirely National Express. The oil and gas there, that my third largest holding is a pipeline company called EPD, Enterprise Products, in the US. And so it doesn't really look anything like I would have expected. And I'm okay with that, honestly. I'd rather kind of just not really be considering this in the moment and just kind of buy companies that I like and that I believe in. And then, maybe once a month is typically what I do, is I just look at this and think to myself, okay, maybe, during the month when I still had Telecom Plus, my telco arm there was looking quite heavy. And I was like, I don't really need both of these. So I do look at it sometimes to make those sort of decisions. But broadly speaking, I don't want to feel constrained by arbitrary numbers, right? So it is what it is. I'm going to keep an eye on this because I think it's interesting to see things like where I'm making the profit. And you can still see here, I've done very well out of technology because I sold out at peak, more or less in most of the big tech companies. I've also been swing trading Genius, and I've been getting back into that as well. So some of that's worked out very well. And then again, the defense and industrials here, which most of it is Huntsman, that's really benefited this month. So almost all of that profit is Huntsman as well. So in terms of my holding size, when I first started, I was just buying everything I heard some nut job on YouTube suggest. So I started with, I think it was 76 holdings, and I've gradually reduced that to the level that I can actually keep up with company updates and stuff. So again, I've started to take a very keen interest, follow quarterly updates, read financial statements, that kind of stuff, which again is something I personally enjoy, which is weird, but we've all got our own enjoyments. That said, I do have my eye on a few new holdings for October, as well as getting back into some of the tech and growth positions that I sold out of. So I will expect this number to go up, and I don't really expect to make too many more reductions in this, maybe one or two where I'm just holding for kind of short-term benefits. But the companies that I have now I really like. So I think I'm at a level where I've got the base, and if I want to increase it, then that's absolutely fine. And again, I don't have a number that I'm targeting. I just wanted to get to the level where I could more actively be a smarter investor. I think that was it. Like I was almost running my portfolio like an ETF. Now I feel like I'm targeting companies a lot more than I was at the beginning. So again, I think that's perfectly okay. More of the same, yeah, and I don't really have anything else. So let's have a look at the dividends before we have a look at individual company breakdowns. All right, so dividends for the year, as we touched on the introduction, at 1717 rounded up. September was my best month to date, if you exclude the very large special I got in March, which I tend to do just because it's such an anomaly so soon into my journey, and brought also as well, like the September month is both my biggest quarter for my US holdings, and it also happens to be a lot of UK shares are done twice a year, and again September and or October tends to be the second month where they pay dividends. So I do expect September to actually be a good month for me moving forward. Yeah, I would say actually I was almost a bit disappointed that I didn't finish above 300. I had expected about 450. And the reason is because I had 3 dividends that were due on the 30th of September that didn't arrive. My brokerage isn't super duper quick, and it is free, so I guess you get what you pay for. I got 2 of them already on the 1st of October when I'm recording this, and I'm still waiting for one more from Huntsman Corporation as well. So, that together is like 185 that I didn't get for September, and those will appear in October. But in terms of what I did get here, the table on the right, I'll just whiz through these very quickly. So Phoenix here, this is a UK listed specialist insurance. It purchases closed life funds primarily. It had a very large acquisition of Standard Life. So its financials look a bit weird at the moment, but I think it's quite transformative. And they're like an insurance company even most Brits haven't heard of, but they're really starting to throw off cash, and I really like the way that they're moving. Johnson & Johnson, I'm just funneling my wife's ISA dividends into that, so that's fine. Microsoft, as I said, I sold out of almost all of my Microsoft. At one stage I had about 20 shares in Microsoft, but got red for a decent profit. Evraz here, I've done a video comparing Evraz to Rio Tinto. I think Evraz is basically a better company, better investment specifically, and I recently basically almost 3x'd my investment in Evraz when it fell to, I think it was 525. I managed to reduce my average purchase price by sort of over 5%. This yields at 13% and has been doing so for many years. It's the 4th best, I believe it is, FTSE 100 performer over the last 5 years, and it basically just throws off cash. It's an incredible cash generating machine, as long as you're comfortable with a couple of Russian oligarchs owning a majority stake in it. It's not without governance risk from that perspective, but a good profitable company that's one of my main dividend plays actually, and you can see that. I mean, that I'm going to be making lots of money from these in terms of dividend moving forward. The next one is Games Workshop, who own Warhammer primarily, is what they're known for. Now, again, at one stage I had 28 shares in this at the peak. I have almost entirely sold out my position as of about 2 weeks ago for an average sale of £118 a share. I felt like they were worth about 120, and I just wanted to profit take and redeploy elsewhere. Since then, they've actually had a really large and probably not really fair or well understood pullback. They've kind of been caught up in the whole, let's sell out of growth. It is a fairly expensive share, even at current levels, more or less £100 a share. It's such a quality company. It just throws off money as well. And they've also got a lot of very exciting things coming up in terms of, like new IP ventures. Very well-run company. They're so busy at the moment that they're having to upgrade their CRM system and everything else. They're just they're on fire. Yeah, have a look at their numbers. I think it's really cool, and especially under £100, I will be looking to put a lot more money and rebuild my stake. Originally, I was into Games Workshop for £97, so selling at 118 was great, and hopefully we can just do the same again, because like I say, it's a very good quality company. Next up is Legal & General, which is another UK insurer. I really like UK insurers, by the way. I've got like sort of over 11% across 3 companies, so Phoenix, Legal & General, and Aviva. But Legal & General probably had the best results of the 3, and more or less, I mean, the results were incredible. I think everyone was very impressed. I almost wish I had more Legal & General. It just seems to be like a kind of almost ETF financial play. It's a lot of like investment stuff in there as well. It just seems to be impressive. The numbers were really good. There's not much more to say than that. So again, this is going to be a long-term holding for me, and I'm going to look to add on any weakness at all. As you can kind of see there, I managed to add about 5% to my share count. Last but not least is LMT, Lockheed Martin. This is very similar actually to J&J, where it's being funneled dividends, but in this case from my personal ISA. So just a broad summary there. But actually all of those companies I like, and even with Microsoft and Games Workshop, I'll be looking to rebuild stakes now that the share price has come down to good levels. So that's the plan for that. Lastly, I do monitor my blended yield across my portfolio, and currently it sits at 4.12%. I would say, especially if you're an American watching this, that's quite high. Be like double what you're used to, I imagine. It is, though. I have a very polarized portfolio, and I have a couple of real eyebrow-raising dividends. Phoenix, for example, is 7%. I think Legal & General is 6%. Evraz, I've already touched on, is into the teens. I've also got another miner called Polymetal, which is like 7.5%. EPD is 8.5%. So like that really pushes everything up. So even though things like Huntsman and BMY, they're only 3%, everything else brings it up. So a pretty good yield, and actually again I'm fairly happy with my balance between dividend income, which I love, and growth as well. So I pick stocks for a reason. So it'll either be because of their dividend or because of their growth, and sometimes both. So that's the plan. Okay, so I've obviously spoken about a few companies, but let's have a look at the breakdown of the 27 companies that I currently own next. All right, so let's see how well my voice holds up for this final section. Just a one-liner in terms of method here. Profit and loss is showing both realized and unrealized, but only from my active positions, which is the ones you can see here in front of you. So that's why, like, if you look on the bottom right, you'll see things like Microsoft and Amazon. I have tiny holdings in terms of my portfolio weighting, but large 3-figure profits, and that's because I realized profit previously. So that's why. So I'm going to pick out a few companies that I'd like to talk about, and we'll start with Huntsman Corporation. This is a company that I believe goes under the radar. I don't see it mentioned at all anywhere, and believe it or not, I only found it when I was looking for some opinions on Huntington Bank shares, which you can see there, more or less next to it on the other side of the table, which is a US regional bank. I think it's number like 300 in the S&P 500. And it has a very similar name, as you can kind of see there. Stumbled across Huntsman Corporation, and I think it's just under everyone's radar. It's like, if you look at it, it's not really a dividend growth stock. Every couple of years they'll do like a 15% increase, but they're not like, it's not going to get you noticed because you're not doing it like 4% consistently a year. They just do it when they feel like it. Also as well, the business is going through like a change fundamentally. So the revenue is going down as they exit low margin businesses, but their earnings are going up. So they're basically becoming more efficient as a business. Almost all of their areas are improving. The one exception is, their resins and polymers for cars, which are also impacted by just reduced production, as I think we're all aware from the semiconductor shortage. Also, I've been on quite a few company calls now, Red Financials, etc. They are literally the only company who, when they mentioned about inflation coming through, were more or less, yeah, we'll be fine, because they don't believe they're going to have any problem passing on inflation, which again to me is kind of a very strong and necessary business. And also another reason why I like them is because they're basically increasing their moat. They're investing in a very large, very sophisticated factory that's going to be the only kind in North America, and they're producing things, like lubricants, for example, for EVs and wind turbines, to just make the running of them more efficient. So they're moving into the right areas as a more nimble business, and I just really like the way that it's moving, and no one's noticing it. This is all supported by a 3% yield, by the way, and it was really interesting when the activist investor came in with a 8% purchase, and more or less said, to start with, we just believe the business is fundamentally undervalued, which, I mean, I agree. It was though slightly clouded because they did suggest that there would be some improvements that they would be suggesting to boost the share price. So I'm kind of waiting to see what they're going to suggest, because honestly I think Huntsman's strategy is correct. But let's see, right? Let's keep an open mind. Hopefully it will be a constructive relationship, and we'll see. But since they've come in, the share price has gone up like almost 20%, and that's been a great result for me, as you can see there by the P&L. I think I've already spoken about National Express. EPD I will just touch on. This is an extremely large and extremely well-run oil and gas pipeline, but really it's a gas company. That's how you should see it. More than half of its earnings are in gas. It's also the world's largest liquefied gas exporter. It's got incredible infrastructure from like ports and storage and manufacturing facilities. It's incredibly diverse, and it has more than 50,000 miles of pipeline, which I just can't imagine that being replicated at all. So it's kind of been given a moat basically by movements into renewables. But everything that we're seeing at the moment, especially in Europe with increasing gas prices, just goes to show you that we're not really ready to transition away from that yet. And similarly, interestingly, with Huntsman, Enterprise have announced quite significant increases in their sale price of gas. So again, this is a company that has the ability to be able to pass on those price increases. So again, from an investment perspective, if not a consumer, that's relatively good news. So again, they're one of my largest holdings, as you can see. This fourth one here is worth talking about. So I mentioned I sold out of Telecom Plus for a different telecoms company, and that is Gamma Communications. So I work in telecoms. I've known Gamma for well over a decade, done work with them, although never worked for them. And I just think they're a very scalable, well-run business that gets it. They produced some results that were more or less bang on in line with expectations, and the share price tanked. Again, it's a very expensive share, in honesty, because it's a very good company. But I was really surprised, and initially I thought I timed it really well. The share price went down 15% on day one, and I more or less timed it perfect. I was like, brilliant. And then the share price just went down another 10% on day two. I was like, fuck. Obviously a bit of knife catching was done here, but I wanted to get into Gamma under £21 a share. I'm into Gamma for like $19.70 a share, so I'm really confident in the long-term direction of this business. I'm really pleased to own them. Bristol Myers, I was kind of surprised just how much I have of this, but I can't believe it's under $60 at the moment. I will be looking to add. I think in general the healthcare sector in the US has been pretty beaten up at the moment, but BMY is just crazy undervalued in my opinion, so I may well put more money into that. And I think I'll just round it out by talking about both Fever Tree and Hollywood. So Fever Tree is one of my real conviction plays. Again, to be honest, another very expensive stock for a good reason. It does mixers for drinks, so kind of like Monster Energy for any Americans, and it's had a similar performance over the last few years. It's really been on fire. It's had a difficult COVID because it was doing a lot of its sales through pubs and restaurants, but it's a superb brand. I love the product. I'm like a big advocate of the product. I think it's delicious, and I've spoken about it before. By the way, I've done a whole video on Fever Tree. I'm buying shares under £23 at the moment because I think that's a good enough place to be, and I really think they're going to bounce back extremely strongly. As my video on Fever Tree says, you have to believe, I think, in 2 of 3 futures for Fever Tree to justify a price around the £23. You basically have to believe that their international expansion will continue at the current pace, which is going really well, like 40% growth, so that's great. You have to believe that they'll be successful in moving into other drink mixers away from gin, which is a very UK drink, and this was a very UK company until just a few years ago, and even they now say they reached peak gin. They just saturated the market, replaced the previous number one, and there was nowhere really to go anymore in the UK and in the gin market. So again, there's some good movements that they're doing in both tequila and whiskey at the moment, so I'm quite excited about that. And the third is that as they've been reasonably successful in off-trade sales, so basically via supermarkets and direct to consumers, even Fever-Tree themselves don't know, and there's significant uncertainty around this last point, is how well the off-trade sales are going to hold up once the on-trade sales begin. Like, is it just going to cannibalize and the off-trade sales are going to fall apart, or have they more or less just created another point of entry to their customers, right? Maybe even added some customers who might not have come across it beforehand in bars and restaurants. I don't know, but for me, I believe in the first two and have some faith that it won't fully cannibalize in the latter case. So again, for me, I like this company. They did reach peak gin a few years ago, and their margins are definitely under pressure, but I think there's very explainable reasons for that, and I think they've kind of gotten over their gin and UK focus that was keeping them held back, and now they're genuinely expanding in the way that they should be. So that's exciting. And lastly here, Hollywood Bowl. So this was at one stage my largest holding, which just goes to show you how much the portfolio has changed over the last 10 months. I really like this brand. I've got one of these really close to me. It's just a 10-pin bowling centre, basically, right? It's not reinventing anything particularly special. Obviously, it's been savaged by COVID. Most of their centres weren't able to open, and I do expect this company to swing, or to basically have a full year loss when they publish their results next week, which is why I want to talk about them. And I'm expecting that loss to be between 10 and 20 million. But that's okay, because they've got 50 million in the bank. By the way, their market cap is less than 400 million, so it's a small company by any standard, especially if you're used to dealing with US companies. But again, it was a really well-run company before COVID. The dividend was like 3%. It was growing, but I think again they've done a lot of good things during lockdown. They've been implementing technology to make pins stack faster. They've started to look at spend per game. Less than 50% of their sales are now coming from bowling. They're going into food where there's better margin. They're starting to open up more centers. They've renegotiated rents. They've acquired distressed locations. So it's kind of just, for me, I think they're starting to lay the foundations. And as long as they can get through the kind of last financial year with a reasonable set of results, I think it's fine. So I'm going to talk about them more, I suspect, over October as their results come out, and we'll get to see them. For me, I would say anything less than a 20 million loss is fine. If they're profitable, I would be shocked, but that would be incredible. Anything more than 20 million, I would start to be a bit concerned, because of they don't have a ton of cash, although it should be enough. But to me, it would really signify that they haven't bounced back as well as I would have expected as COVID lockdown's been eased. So that will also be interesting to see as well. So anyway, the rest of my shares are displayed here. I do talk about these during the week in terms of what I'm buying and selling. So any questions, feel free to ask me in the comments below. I try and be incredibly transparent in these videos, so hopefully that's valued. Even though this is almost a 30-minute video, I hope it adds some value. I hope you enjoyed it. If you did, like and or subscribe, whatever works. Otherwise, I've been the Boss Hog. Thank you for watching, and good luck with your investing, everyone. Bye for now.